Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, March 6th, 2021, and this is the weekly market update. Short disclaimer, nothing that you hear on this video or podcast is investment advice. Do your own research as it's your money. All right, in this week's reality check, got a few reader emails and messages, a lot around the recent moves that we've seen in a lot of the resource stocks. As you know, the Actionable Intelligence Alert newsletter has just been going nuts as far as the returns we've been seeing in a lot of the holdings. Why? Well, we are focused on things that are out of favor and undervalued, and currently that was the resource commodity sector. And we had a view that at some point, because of the lack of investment, that would turn around. That's now happened. So we've got a lot of emails and recent subscribers, quite a few actually, and people are saying, wow, these things have really moved. Is it over? What should I do? This is pretty typical. Like, these aren't like actual messages. These are just like kind of the putting them all together. I missed the initial liftoff in the oil trade. Have I missed the trade? When would be a good time to buy? No, you haven't missed it. I mean, obviously, it would have been better to buy 6 months ago or, right after the crash. But no, you haven't missed it. Why do I say that? Well, I mean, you can even, for example, a company I've talked about on this show in the recent past, Suncor, which is a very large Canadian oil sands upgrader in Canada. They also have a refining component. So it's a very large company. It's a large cap. Actually, Berkshire Hathaway, Warren Buffett has a position in that. But if you look at the current share price, it's still well below where it was when oil was trading at $65 a barrel before the COVID-inspired crash. So that's just one example. Right now, do I think it's being held back a little bit? Yes, because the media talks about pipeline issues and all these things. Also, the company has some. They put on some hedges at lower prices. They're not getting the full effect of the rising oil prices, but they are getting some effect. So that's just one example. And these things, when they initially blast off the bottoms, I mean, when you were buying these things at basically giveaway prices because of all the media hype around, the oil industry is going away, ESG, we're going to all be driving electric cars next year, that contributed to the sell-off. And, a lot of the things that were holding the oil price back are now dissipating. The shale situation got decimated. We've seen most of the shale companies are holding to the line of saying that they're going to try to live within their cash flow and not go out and borrow money. I mean, that's what they were doing, right? They borrowed hundreds of billions of dollars, put it into the ground, and then basically had negative cash flow and no earnings. So they said they're going to change. We'll see as the oil price goes up. I anticipate it's going to go a lot higher going forward over the rest of this year and into next year. As a matter of fact, I believe that once the economies come back, and they're starting to now, as we've seen many, many states in the U.S. lift COVID restrictions, mostly red states, Republican states, you're going to see more of that as the spring and summer comes along. And I'm projecting that oil demand in the world will be higher than it was pre-COVID. Why? Because in order for economies to grow, they need energy. And whether people like it or not, that currently means hydrocarbons. But no, you haven't missed it. So a lot of the stocks have moved and a lot of them are overbought. So you should take a look at a chart, use stock charts. Just the basic chart that you put up can show you moving averages, the 50-day, the 200-day. It'll show you the stock price in relation to those. So if you're trading well above those moving averages, you can expect a pullback. I mean, even in a bull market, you're going to have pullbacks, right? So we're in a bull market. So what should be done in a bull market is you should buy the dips. So that's my suggestion. You don't have to throw all your money in. You don't have to panic. don't get FOMO. You missed the initial blast off, which was a good move. Some of these stocks moved a couple 100% already, but it's not over. And like I said, even some of the large caps are still priced lower than they were doing before or the last time oil traded at its current level of around 65, whatever it's trading at today. And so, yeah, you haven't missed it. Buy the dip. That's what you do in bull markets. And we're in a bull market until, further notice. Don't expect that you're going to get some huge pullback, though, of 50%. Some of the juniors could pull back, more than average on a pullback. I mean, nothing goes straight up, right? So, but if you're thinking out a year, 2, 3 years, or at least a couple years, I think that if you buy on some dips, you would probably be okay. Same thing, I've got the same discussion around uranium stocks. Everybody wants to get into uranium stocks now, right? It's the hot thing. Everybody kind of sees the obvious, and more capital starting to come in, you know. And one of the things somebody asked me was, well, uranium stocks have soared. How do you know when to sell? And first of all, we're nowhere near the end of the bull markets in these industries of oil and gas and uranium. How do I know when to sell? Well, I've talked about this before, and I guess it requires me to get into it again, which I will. You have to have a plan. You have to have an investment plan. You have to write that down. What are you trying to achieve? In the context of writing this plan for yourself, you have to do some self introspection. How much risk are you able to take on? If you're going to lie awake in bed, staring at the ceiling, sweating, and getting a upset stomach because a stock that you bought dropped 30 or 40%, regardless if the fundamentals changed, you probably shouldn't be investing in the stock market at all. A lot of things that I am talking about are out of favor, contrarian, things that are deep value. And sometimes it takes, well, not sometimes, just about all the time, it takes a lot longer for these things to turn around than even I think. And I'm very patient at this point in my life. I mean, I used to have the FOMO. I'm going to miss out. I'd throw my whole wad in on something. I wouldn't, scale in tranches. I would just, and then, I'd buy at an intermediate top, have a 20% correction, and then, be all bummed out and, sell out. And then the thing would recover because you're in a bull market, and I would be, upset. So if you want, let's use some sports analogies. Where do I think we are in both of these markets? I don't know, top of the first inning in a 9-inning ball game. I mean, that's where you're at. These things have a long way to go. So I wouldn't even be thinking about selling. What I would be thinking about doing is how to put new money to work if I had it. And that would be, like I said before, scaling in on any type of pullbacks. You should have, but you should have a plan, You should understand what your risk tolerance is in the plan. What's your level of knowledge? If you're a newbie, you're going to you got a lot of catching up. You got to do some work. That doesn't mean you should just sit out, but, maybe you shouldn't be investing in, or speculating in. That's what you're really doing in a lot of these uranium stocks. I mean, let's just be honest here, guys. There's one investable company in the uranium sector. That's Kazatomprom. It's the only company that actually has earnings. Okay. Even Cameco doesn't really have earnings, right? And the rest of them are speculations as to whether they will ever produce any revenue or cash flow. That's from an investment perspective. You have to designate between investing and speculating. Speculating is far riskier. That means you have to put the time in. You have to understand what you're doing. You have to create this thesis, understand it, and if it's in play, then you have to go and look at, how many, uranium mining is a very specialized industry, right? So at the peak of the last uranium bull market, there were 500 uranium companies. At the start of the last bull market, there were 2 or 3, I think 2 originally, 2 or 3 publicly traded uranium companies. At the peak, there were 500. Were there actually 500 competent uranium mining or uranium, uh, skilled teams out there? No. It's the same thing in all these industries. They have the same in Toronto and in Vancouver. When the ducks quack, feed them. So, now we've got about maybe 50 trade names that trade out there that are in the uranium business. I say that with quotations. but one of them's only investable, and that's Kaz-Adamprom. The rest are speculations. You need to understand that. And then if you're not able to do the research, or if you don't know the research, then you're going to have to get some advice. Who would I get advice from? Okay, well, Justin Hune has a newsletter, Uranium Insider on Twitter. I don't subscribe to it, but I've had a lot of conversations with him, and he seems to be switched on, and he's done fairly well in his newsletter. I have a few picks in my newsletter. If there's ETFs out there. If you understand the general top of the general overview, the 30,000-foot view of where uranium's going, and you understand that, and you think that that's a cogent, correct argument for higher uranium prices, then just buy the ETF, scale into it over time, dollar cost average into it. That's an option. That's probably the best idea for most of you guys. But what people think is they see a tweet or they see the story about mega uranium during the last bull market that went up 10,000%, or they hear the story about Rick Rule and Paladin, and they think they're going to pick that stock, right? The chances of you doing that are very low. So, but that doesn't mean, it's like setting realistic expectations. Another thing that I harp on. The average return over 50 or 100 years in the stock market with dividends reinvested is about 9%. And so somebody's going to sneeze at a couple 100% return because they caught the wave on, and they expect that's normal, or 1,000%. A 10 bagger is not that, read Chris Mayer's book about 100 baggers. They're not that common. 10 baggers are not that common. Think more like a Tony Gwynn or Rod Carew. You want to be a high average hitter. You want to, you can make a very nice career. The difference between a 300 hitter in baseball and a 275 hitter in baseball is about $10 million a year in salary, if you get my meaning. So, what I'm trying to tell you is that you haven't missed it. Don't panic. Don't try to get FOMO. Calm down. Get your biases under control, and then create a plan. Okay, how much capital do you have? How concentrated are you willing to be? Do you understand the investment thesis sufficiently? You should write it down. Your understanding of the uranium supply demand, or the thesis for why uranium's going up, and write it down. Then you should revisit it on a regular basis. Is it still intact? Because that will help you determine later on, which is another question, when to sell. And this is, this bullet point I want to bring up. Investing and speculating is a personal journey. It's what works for John isn't going to necessarily work for you. I have a different education level, experience level. I've been around this a long time. My connections are probably different. I've already got the battle scars. My risk tolerance could be different. Everything's different. So it's going to be different for each person. The answer is always going to be different. And I can't just give you, here it is, guys. Here's the Holy Grail. Here's this book of wisdom. I can publish it, and charge you, $49.95, and you're set. That's just not how it is. That's why this game is harder than people think. But it's not impossible. It's not a bad thing. You just got to do some thinking on this. And people don't want to think. I mean, people would rather just be told. I tell the story, in my younger days, in my 20s, early 30s, I was involved in greyhound racing. Various investment syndicates, we would have interest in various dogs or bloodlines. I kind of regret it now. It's kind of not a very good industry to be involved with. But anyways, I never really gambled on, well, I'd go to the track and watch my dogs race. If there was a stakes race, one of them was in, I'd go there. It was fun to do with the other owners or people involved. And maybe I'd put $2 on to win. I wasn't really, but there was these people there, and they sell these like pamphlets, right? Tip sheets or whatever, tout sheets. And somebody, because these people are like degenerate gamblers, right? They just want to, somebody give me the Holy Grail so I can turn $2 quinella into, or hit the superfecta for $4,000, and all my problems will go away. That's not how it works, man. It's really not going to work that. And I see these people, and I was just like, this is not good. But you see the same thing in these markets, right? People chasing the shiny objects, people looking for the easy way all the time. That's just human nature. And you have to fight against that. I went through that in my investing career. You got to fight through it. You got to overcome it, because it will tear you up. It will lower your returns. It will keep you from uh, being successful in this game. Again, what are your goals? What's your risk tolerance? What's your aptitude at this game? Like I said before, I mean, I can't forget which great investor said this, but he talked about like all the analysts he has, all the resources he has, all the connections he has, and you're competing against that, and you're working a 40-hour job, then coming home and working on your house and playing with your kids, and then spending time with your spouse or whatever, and then you're gonna go and like invest. So I think, getting a theme correct and saying, yes, I think oil prices are going higher, or I think uranium is going to go higher, and this is why I agree that thesis is correct. Just buy an ETF. That's the easiest way to do it. You're not going to get the big returns, but you're not going to miss the move either. And it takes the burden of doing that deep research, or find some people. Get on Twitter. That's why I tell people, get on Twitter and cultivate follow people that are smart. Over time, you could see that their calls are correct, and could start understanding. You could start interacting with them. Like, why do you think this is going up? You said that you were correct, but what was your thinking? People interact there in FinTwit, and there's a lot of smart people. Create your own analyst community. Reach out, have connections. So what do I do? Well, I enter and exit positions over time, right? So when I feel like I find a sector, let's just use like the oil sector. I just didn't take a bunch of investable funds and throw it all in at once. I started identifying companies that I thought were going to benefit, and then I start scaling into the position. I buy a tranche, and then I watch what goes on, and then I might add to that. Okay, I double down if I think that if the price drops back, but the fundamentals aren't changing, I'll add more. If it's in a rising trend and like the price is just taken off, but I'm not forced to, right? I don't have to chase it. Okay. And then I don't have to get bummed out if I buy a position on my first tranche and the stock drops 20%, because that does happen more often than not, especially in these bombed out industries. You buy, hasn't done anything for 3 years, or it's been down for several years or many years, and you're sitting there thinking, okay, this thing's going to turn, but the turn ends up taking longer. And then, something that's down 90% can still go down another 90%. That happens. That can happen. So you don't want to buy a position, throw your whole wad in, or your allocation that you wanted to allocate to oil stocks, and then the thing goes down 20%, then you're bummed out and you sell. And, then a year later, you look at it and things double or triple. That happens. So you're not going to catch the exact tops or bottoms. Just get that through your head now. I tell the story about Bitcoin, the last bubble in Bitcoin. It topped out at what, 19, 20,000? I don't remember. That's when I started this channel, when I was riffing on how it was a bubble back then and people should get out. People were buying credit cards. That Studying these bubbles, studying sediment, studying what goes on in the media, studying what people say on social media. You can use Google Trends, for example. It's one of the tools I use. That can help you decide when to sell. When you go and everybody and his brother is talking about buying Bitcoin, and these people don't know anything about anything, that's a bubble. Who else is going to buy after this putz? The dumbest person in the world that doesn't know anything about investing. Nothing against Uber drivers. If you get in an Uber and he's talking about buying oil stocks, you probably should reconsider. What's this guy know about oil stocks? He might be the one guy that knows what he's talking about, but you know what I'm talking about. You go, that's what was happening. You go to it was right around the holidays too. I remember when that happened. And you go to a holiday, and the goofy cousin or your ex brother-in-law who wears the jacket from one suit and the pants from another is telling you how much money he's making in Bitcoin. That should ring alarm bells in your head. This guy doesn't know anything. So you got to look for those kind of clues. It's kind of more of an art than a science. And there's books out there. Humphrey Neill's book, The Art of Contrary Thinking. You should be reading these things. You should be educating yourselves about bias and about market history and what indicates of a bubble. We're talking, everybody's, dunking on Cathie Woods and ARK Investments down huge. Of course it is. Of course it is. She was riding the wave of the FOMO and all the stoops that don't know anything. But she's no different than Gerald Tazai back in the go-go nifty 50 days. It's the same thing. History repeats. The actors just change. The play stays the same, guys. The script never changes. What, you don't think we've had bubble? We had, we had in the tech bubble, we had Henry Blodgett. The same thing happens over and over and over. You just got to study it, and that's how you become knowledgeable and understanding when you can recognize when something, the sentiment is too bullish and it's time to start scaling out. Now, getting back to my Bitcoin story, I've told this many times. I was buying Bitcoin, a couple $100, whatever, messing around with it, adding to it, blah, blah, blah. I think I was mining some Bitcoin with somebody just as an experiment. We were messing around with it. And, I think it topped out at, I think it got to like 4,500. And I said, this is a complete bubble. I'm out. Now, some of the positions I have were up, 10, 20 times. Were you going to get upset because it went up 10 or 20 times? But I didn't know what the exact top was going to be. It was so frothy even at that level. And then it subsequently went on to 20, 20 grand. But you can't do it. Like, you can't get upset. So I scaled out. I'm happy. I paid my taxes and I moved on to other things. All that money got recycled into uranium stocks. So, here we are. We're at the beginning of this, what I think is going to be a tremendous bull market in uranium stocks, which has started. So anyways, I kind of jumped around a little bit like a frog on a lily pads, jumping back and forth, but I think you get the gist of what I'm saying. I've talked about this before, and this is really directed to a lot of you young guys and newer people that are listening or new subscribers. Don't get like overly excited. You could scale into these positions. These are things that are going to play out over some time, 18 months, 2 years, this commodity deal. And it's nothing just to take your whole wad and throw it in tomorrow because John said. I mean, don't do that. I'm giving you ideas that you should research more. And then you have to make the final decision. I'm not trying to cop out and take responsibility. I have a tremendous burden getting on here, talking to people and trying to educate people. And I think about, when the newsletter first came out, I was not doing well because we was a lot of contrary positions in oil and gas. I made a call on offshore oil drillers, and most of them went bankrupt. A lot of them were down, 90%. But I didn't have all my capital in them. Okay. And, I lost money on that, but other people, lost money on that because they were listening to what I was talking about. So there's a burden there. But like I said, in the end, if I'm getting stoked about offshore oil again because they've all went through bankruptcy. They're rationalizing their businesses. They're coming out stronger. That's a whole nother story. That's a whole nother video. But you see what I'm saying? So you really got to take responsibility, which is, you're being told by everybody in media, academia, government that you don't have to take responsibility. But in this game, you will. This is one of the last pure meritocracies left. You either get it done or you don't. You either know what you're doing or you don't. And if you know what you're doing, you get rewarded. If you don't, you'll be shining someone's shoes. That's just how it is in this business. All right. I just wanted to show this. You know what my feelings are on the disease that cannot be mentioned. Maybe it's not funny because a lot of people have died, but a lot of people die from smoking every year too, 400,000. But I wanted to point this out because there's so much media hype around this and so many people are scared. I mean, it boggles my mind when I see somebody driving around with a mask in their vehicle and no one else is in the vehicle with them. It's like, what is this person thinking about? And I thought this was kind of instructive. Here you have this, looks like this typical young lady here with a little backpack, and she's probably walking around Pennsylvania, Amish country. She's got a mask on outside. And, this is kind of a joke. I'm sure this wasn't the conversation. She's probably asking about butter or where they sell rocking chairs around there. But anyways, she's saying like, why isn't COVID affecting you people? And the Amish dude says, we don't have TV. I mean, it's a lot of this is agitprop, right? Soviets used to be accused of this and agitation propaganda, and I didn't think propaganda would be as effective in a country like the United States, but I guess I was wrong, especially on this deal. I mean, they really have a lot of people scared out of their minds. And, it's kind of funny because they lifted the requirement here in Texas for masks, but of course, all the stores, I think it comes down to CYA, kind of like Louis Gov was talking about. A lot of this is CYA, right? You don't want an employee working at Walmart or Target to get COVID because the store got rid of masks, then the person sues the company. I think that's what a lot of it is. But the fatigue among average people, they're just tired of this, or they just go along with it. So, get frustrated. And I think that, as time goes on, the willingness to go along with this is going to decrease. But I thought it was kind of funny, right? I mean, turn off your TV. If you're listening to CNN or Fox or, I mean, it's all propaganda. It's all biased reporting. And, I find that if I really want to find out what's going on in the US, I kind of like look at media stories from outside the US. It's kind of interesting. You'll notice that people that cover the United States from Europe or Asia probably have a different view on things than people here. So, anyway, I just thought this was kind of humorous. I found this amusing. Okay, this is really great news, guys, for what we're talking about uranium. I want to get back on this uranium thing. So, China, they have these 5-year plans. It's it's a communist country, right? Yes, they have capitalism. People can get rich, and it's glorious to get rich and all that. But in the end, it's still a command and control type situation. So when the Chinese government comes out with a 5-year plan, they can get things done because everybody's got to comply with it. So it's from an article. I'll attach a link to it in the show notes. But basically, the nation will promote the construction of coastal nuclear power plants and aims to have 70 gigawatts of generation capacity by 2025. That's 4 years from now, from about 50 gigawatts at the end of last year. That's almost a 50% increase, guys. According to the latest 5-year plan presented Friday to China's annual National People's Congress, that would equate to about 20 new reactors. And we know that a 1 gigawatt reactor probably uses, I think, around 500,000 pounds of uranium, a little bit more than 500,000 pounds of uranium a year. And the initial loadout is 3 times the loadout of the annual use. So, again, I said this before, after Fukushima, China put a moratorium on construction. They were still building the reactors they had under construction, but they reevaluated their designs and all their construction techniques. But they opened that back up. I like this thing here too, because I want to point this out. The fact that the nuclear sector's future is being laid out in fine detail, unlike some of the alternatives, including solar and wind, that's very important. Everybody touts here in the West, oh, China, one of the biggest wind and solar. Yeah, they are. Because they have a huge industry. And guess where we buy a lot of our solar panels from and where we get a lot of our wind components from? China. So they're selling us a less diverse or less, what do you call it? A less concentrated type of power. We're sucking it all in, sending our money to them. We're not manufacturing these things in the United States because of the cost. They're selling it to us. In the meantime, they're buying nuclear and they still tout it. I mean, you'll hear people on the left here, oh, China, they're leading the world, but they don't really set any real goals or really do anything. I mean, if you go to endofcoal.org, you can see all the coal plants that are still being built there and being planned. And then you just see this. And this is concrete. I always watch what people do, and I don't put any stock into what they say. It only matters what someone does, not what they say. And they understand base load, and they understand that they need to have base load power. And, for the electricity demand that's going up. It also reflects the new impetus behind the sector after a 3-year freeze on plant approvals that ended in 2019. That's what I mentioned earlier, and that was lifted. So what you're seeing here is, which I think is interesting, is this continual bifurcation between the West and East, where the West has went cuckoo with the ESG, and we're going to run everything off, intermittent power that's less concentrated. These energy transitions that they're talking about having, we've had before. We've had energy transitions before. They don't happen in a year or 2 years. They take decades. And I think what we're going to find out is that it's not going to work out like people think. And why we would self-destruct ourselves for these mandates. What's going to happen in 5 years? China, India, Russia, a lot of the emerging markets in the East, in Asia, they're not going to comply. They're not going to go along. So what's the EU and the US going to do? The EU and US are bankrupt, old from a demography thing. They're losing their stature in the world, eroding politically, socially, morally, economically every year while the East is on the rise. And then we're going to wag our finger at them, or we're going to threaten them in the UN. What are we going to do? Have sanctions against them? I mean, I don't understand what the plan is. They're not going to do what we're doing. We're putting ourselves behind the 8 ball, and we're going to fall behind. And they're going to get rich off selling us the means to our own economic suicide. You know, there has never been an energy transition in the history of the world that's went from a concentrated form of power to a less concentrated form of power. The energy transitions have went from a power source or a fuel source that was less concentrated to a more concentrated. Okay. And I don't know what we're doing. So, you know, I've talked about this before. I'm kind of getting on my soapbox again. I'm trying not to do that as much around this because I'm trying to stick to the heads we win, tails we win more investment thesis around this. You know, it doesn't really matter what John thinks or any of you think. Politically, this is what the West is going to do. They're going to force it. I mean, there's reports now in the media. I could have put them up here, but you know, I'm hearing more and more that some city in California now has banned any gas stations in the city. Okay, I mean, you can force everybody to buy an electric car, but we'll see how that works out. You can force everybody to use solar and wind. The government can mandate this. And it goes back to, like I said, the conversation I had with Malcolm Rawlinson a long, long time ago when I started the interview series. What's going to change this nonsensical, stupid way of thinking is the cost is going to go up and the pain is going to be there. It was painful for a lot of people here in Texas, when they lost power for a week, in some cases. People died. Now, I'm not going to get into that whole story again, but you're going to expect to see more of that. And as economic activity contracts over time, because you need energy to power industry and things like that, that's an input price. And if you raise the price of energy, it makes it more difficult to compete with people around the world who you are competing with in other countries if their energy costs are lower. That's another advantage you give them that you shouldn't. But we'll see how it plays out. Like I said, our goal is heads we win, tails we win more. And this is a perfect example, right? What's our thesis around uranium? Supply's going down, demand's going up. Here you go, more demand. And China is perfecting their designs to the point where they're exporting their designs. I think I just read of a Chinese designed reactor in Pakistan that just went critical this week. So rest of the world's moving in this direction, and we're going in a different direction. But there's, we're going to catch them coming and going. I wanted to put this out. I'm a big advocate of gold. We've had interest rates really going up. We've talked about real rates before. What's this chart showing? Okay, so you have the light blue line is US CPI inflation, okay? And the dark blue line is the ISM composite or the purchasing managers index, whatever you want to say. It's basically an indication of manufacturing and economic activity. And what you see is that typically what happens is that as the ISM, as economic activity increases, you start to see the inflation rate increase, which makes sense, right? Because as industry ramps up, the ability for prices to be passed on, that lags, right? And we've seen in the past when this ISM number here, you see how bad the inflation rate's lagging. This is always going to lag, right? This is going to take off first. And then as the statistics come in on a 1, 2, 3 month lag from the government, this should follow. And we've seen that in the past, right? So what we can expect to see is this is back to rates like around 2008. Remember when oil was $148 a barrel? When economic activity was really high right before the great financial crisis. Yeah, this is the tech bubble. You see that things were ramping up here. The inflation rate goes up. And so what typically happens as inflation increases, we know that interest rates are usually raised by the Fed to, take the punch bowl away, to dampen economic activity, to get inflation under control. But what the Fed has said is that they're not even thinking about raising rates, and that they're willing to let the inflation rate run hotter. And so what we've seen recently is the market-based rates, like the 10-year Treasury, have are moving higher in anticipation because they see this real-time data. Also, the bond market sees that. The traders in the bond market, they see that economic activity is taken out. They know this. The bond market traders are very smart. They're typically way smarter than people that trade equities. And they know that in the past, when they see this, that they can expect inflation to go up. So that means that they need to price bonds lower and the rates need to go up. But the Fed now is getting them, this is part of that, you know, Fed getting themselves into this quandary. They can't really raise rates on the short end because if they do, that's kind of going against what they said, which was they weren't going to raise rates for a long time. So they've painted themselves into a corner. We've talked about this before. And so what's happened is gold's really pulled back because real rates have went down. Why? Interest rates have went up, but the inflation rate, as you can see here, is lagging because the new information hasn't come in yet. And as it comes in over the next couple months, you'll see this number move up. Uh, you know, we can expect to see maybe 4%, 3.5%, 4% inflation this year. Okay. And when we do, the real rates will get progressively negative, and that's when I suspect gold will take off. What do I think will be the catalyst for the gold reversal and move higher? I think as rates move higher on the long end, the Fed, a lot of analysts are saying this, and maybe I'm wrong, but they can't let rates get too far out of control. They're going to have to come in with yield curve control, and they can do that by buying up as many treasuries as they need to. Now, that will be negative for the dollar, and that will be a signal to gold and other commodities that they'll just go on a rip roaring rally. So I don't know what they're going to do. We'll see. It's impossible to know with certainty, but I'm just going on what they said. If they don't do that, if they turn around and say, yes, we're going to get serious about inflation and we're going to raise rates sooner than we told everybody, the stock market will go down 30 or 40%, like quick. I'm not saying a crash, but they've painted themselves in the corner with these markets. They're damned if they do, damned if they don't. Now, they have said in the past that they are going to let inflation run hotter, but they were talking maybe, 2.5, maybe 3%. I don't think they were expecting 4 or 5% or maybe even higher inflation, which we could see over the next year or 18 months. Uh, we'll see what happens. But I suspect as these states open up, as the pent up demand comes off, um, as we see all this savings that people have get unleashed into the economy because they've been basically imprisoned in their homes for a year, you're going to have a tremendous surge in the economy in the second and third quarter, and we could see prices go through the roof. And that's just worldwide also. I mean, if you look at like some of the booking data around vacations, some of these resorts are sold out already this summer. I mean, we've talked about this in the past. A lot of the airlines are already booked up. You can't get flights this summer. So it's going to be interesting to see what happens. We'll have to follow this, but I suspect that's kind of the thesis that I'm working from now is that as the 10-year gets closer to 2%, they're going to have to come out with a statement and say they're going to, hold rates to, you know, and that will be the signal to the gold market that, okay, well, if you're going to lock down the long-term rate on the 10-year and inflation's running 3 or 4%, then the real rate of interest is negative, and we've talked about that enough where everybody knows what that means. But I wanted to show this because this is really what's happening, and you could see in the past. I mean, everything repeats, like I've said, and you could see that at this particular ISM reading, and this thing's screaming higher. I mean, it's not like rolling over yet. I mean, what if we get back to these levels like in 2005? You could inflation over 4%. In 2008, you had inflation pushing over 5%. If we were to see that now, and they had yields locked at 2% on the 10-year on yield curve control, you'll have a negative 3% real interest rate, and gold will be it'll make all-time highs. So something to keep in mind. Wanted to talk about this. OPEC shocked the market this week, said that they were going to hold their cuts in place. And I wanted to show this. Why are they doing that? Well, they want to, I think they want to test and see what's going to happen. We kind of got, finally it went our way, right? I mean, we've got double clutched by OPEC and Donald Trump on these oil markets over the last few years. But this kind of gives you a good idea, I think, where OPEC's thinking. I mean, these are the break-even oil prices that the various OPEC members need to balance their budgets, right? To get a physical break even for, and here's the big players, right? Saudi is right here, $78 a barrel, Russia, 71. And on Brent, we're pushing that, right? We're getting close to that. So I think they want to test it. They want to see how far they can push the market up. Another thing that's going to contribute, I think, to the oil rally is a lot of the oil sands producers in Canada are taking their maintenance outages over the next 30 to 45 days. And so you're going to see Canadian heavy oil down by about 500,000 barrels per day for the next month or so. That should that should keep the oil price elevated. You should see the inventories continue to work down lower. And I think we really want to see how shale responds. Does drilling increase? Do frac spreads increase? And will the shale guys maintain their discipline? Now we're seeing the rig rates starting to creep up, but still insufficient really to even hold production even. So far so good on that front. We'll just have to see how it goes. If oil gets to a certain level, money will come back into the patch and you will see drilling increase. But there's a lag to that too. You just don't flip a switch and increase oil production. It would take a good year to at elevated drilling rates to make a difference. So something to watch. I think this has a lot to do with it though. You could see, $75, $80 a barrel is what a lot of the big players in OPEC are going to need to see for their, 95 is the average. You see Iraq and Iran are even higher. Forget about Venezuela. I mean, it's a basket case, but that's kind of an outlier. But this is really that, $80 is what I'm saying for next year, 70 this year and 80 next year or higher. So we'll see. This is a tweet this week by our friend of the show, Trader Ferg. He was talking about, and I think I have a link to the article. I was reading about this also. I will put it out. He's talking about BP. BP is going to go green again. They've already did it once. Remember when they changed from British Petroleum maybe 20 years ago to Beyond Petroleum, and then oil prices went up, so they kind of forgot about their renewables and Beyond Petroleum. They got back into petroleum. Now they're getting out again because of ESG, and they're scared of the Twitter mob. And so what did they do? They sold a lot of their properties or some of their properties at fire sale prices, and then they overpaid. They're overpaying for these offshore wind assets. And I like what he said here. This is the most efficient way to destroy shareholder value I've ever come across. And he's quoting from one of the articles. BP won 1.5 gigawatt UK offshore wind leases in February by bidding almost double the amount fetched by similar sized leases at the same sale. So this is what happens, right? This is contrarianism. This is what you should be watching. This is a company that's completely converged by the left wing, by the Twitter mob, by the ESG movement, by wanting to, get the accolades, get a plaque from the prime minister, and everybody tell the CEO how wonderful he is. And what are they doing in the meantime? They are an oil and gas company. That's what they should concentrate on, and they should tell everybody to go pack sand. But they're not going to do that. And what they've done is, they're going to sell things that they are good at for cheap, and then they are going to buy things that they know nothing about at 2 times and pay twice as much. And when oil goes to $100 or $150 a barrel in several years, which I think it will, they'll get rid of all, just like they did before. They've been through this cycle before. They'll quietly get out of the renewable business or scale it tremendously back, and they'll be back in overpaying for probably some of the same properties that they sold. I mean, you can almost write a book about this. This is the cyclicality. Then you throw in politics, and it just makes being a speculator so juicy. Okay, this title of this slide, "The Stupid It Burns." What is this? This is from Deutsche Bank. U.S. retail investors plan to put a significant chunk of any forthcoming stimulus into the stock market. I mean, really? Please stop it. Stop it, guys. Please don't put stimulus checks in the stock market. I mean, really? And who's doing it? By age group. Here you go. Here's where a lot of the proportion of people that are 18 to 24, 40% of them are going to put the money in the stock market. 25 to 34, that's our audience here listening. 50% of the people in this age group are planning on putting any stimulus checks into the market. And of course, you know, people with that have on the lower income scale are involving themselves in this. And here's another thing that really gets me. Here's the experience level. Investment experience, less than 12 months, 43%. Yep, chasing the shiny object. Seeing everybody else around them get rich and they're not. It's easy, right? Because stocks only go up. And it's, you know, it's like I've been watching these videos on YouTube about like these guys that do like on Rue bets and stuff. They play these games, and that's kind of what Robinhood. I mean, they're betting these huge sums of money in blackjack. I mean, $10,000 a hand. They're putting it on YouTube. These crazy games they have on there. I mean, they're entertaining and stuff, but that's, you know, in the end, you lose money when you gamble. The house always wins. And if you're in this cohort and you're planning on taking your stimulus check and put it into the stock market and you have less than 12 months, I mean, if you're in this thing right here where you don't have any experience, you're just gambling. And like I said, when you're gambling, the house ultimately always wins. Wanted to talk about this tweet. So basically, let me explain this. This is year-to-date return. This is the year. This is the charts for every year going back to 1973 for the returns for the S&P Goldman Sachs Commodity Index. Okay. And what we're showing here is this year, and basically it's the second best start for commodities, you know, with talking about the S&P Goldman Sachs index since 1973. And I expect that that's going to continue. But this gives us a good guide, right? What could we expect in a typical good year is to see this index up 40, maybe 50%, right? And we're on track if we're on the second best start, you know, with all the tailwinds we have around all the money creation and some of the undersupply dynamics, you know, we could conceivably see, you know, if this thing goes up, if the GSCI goes up 40 or 50% in 1 year, a lot of the underlying commodities and distill it down further to the commodity stocks that produce those commodities could be up hundreds of percent. So I wanted to point this out. Everybody's talking about a super cycle. This kind of confirms what's going on. Commodities across the board, raw commodities, industrial commodities, a lot of commodities that are traded on exchanges, everything's up double digits. And I don't know, we'll see how that plays out. But right now, everything is going in our direction. Okay, that's it for this week, guys. I hope you got something out of this. I appreciate it. Like I said, keep the questions and comments coming. New subscribers, you know, we appreciate you coming on. And like I said, I do this for you guys. Yes, it's basically to market my newsletter, but I think a lot of good information gets put out here. I get a lot of good emails, a lot of direct mail or direct messaging on Twitter. Follow me on Twitter, guys. You get on my Twitter feed, you'll start running into a lot of smart people that are way smarter than me. And you can start getting that education that you need to be successful in these markets. All right, guys, that's it for this week. We'll talk to you next week. Thank you.